This is Martin from Secrets, the channel for learning about trading and investing. Welcome to Markets Next Week, the weekly stock market analysis show where we look at what happened in the market using the technical charts, try to learn something from it and then plan for a better trade for the upcoming week that's starting from November 6th, Monday, 2023. If you're not subscribed, please subscribe and share it to your friends and colleagues so that this video reaches out to the maximum number of people. Let's get into the charts first. This is the weekly view that we have been seeing since quite some time. And left side you have the Nifty and right side you have the Banknifty. We know that we had rounding pattern breakouts and then flags, multiple flag breakouts, and right now if you slightly change the channel of the flag, the last one, you can see that we're still in a in the third flag breakout zone, which has the top part as a channel, trend line channel. So that's what we are. We cannot say that the rally is over. We are still in a breakout rally, is what the broader view indicates to us on the Nifty and the Banknifty indices at least. This is another view, weekly view. We can see that it's a trend line channel that's where the indices are held within, and we had resistances that appear clearly as an M pattern on Banknifty especially, and we were sliding down after hitting that since several weeks, and then markets have taken a pause, taking its own sweet time to decide as to move ahead once again towards the channel top, or to pull back a little bit and then come down to the bottom of the channel or not. Banknifty also went a little more closer to the bottom of the trend line channel and then taken a pause, have an inside bar, and then taking its time to decide whether to move up or consolidate for some more time or move down to the bottom, and all of that. That's another view. The daily view is showing that the consolidation breakdown had happened, and it's an attempt to reverse back, and there are small body candles that had formed but with multiple gap ups in both indices. There is indecisiveness and there is attempt to recover from the fall, and then the previous consolidation zones would now act as resistances on the upside. Also, we know that Nifty has held, and the mounts that happened from the 200 exponential moving average, where Banknifty had lost that long back and then still not able to climb over that and then settle above 200 exponential moving average. Probably, yeah, it tried to climb over and closed it. But not on a weekly, not on the daily charts yet, right? The 200 exponential moving average, still there. So that's the first hurdle for the Banknifty. This is the candlestick view. You can see that a decent bullish candle is what weekly it's formed, but it is well inside the big red candle that caused the vertical fall in the last week and the week prior to that as well. So that inside bar indicates that probably this market is not ready to fall down further from here immediately. Market may take some time to consolidate at this zone within this candle, and the moment this candle is conquered and price moves out of the 9500 zone and 44,000 zones, then we may be convinced that the rally is over. But similar kind of bullish candle, but well within the big red candle. Inside bars is what. So that's fine. Inside bars often indicates that there is some consolidation after a big move. Daily candlestick patterns, if you see, it's very interestingly, it's gap ups that has happened the last 2 days, and the last 3 days we have gap ups in the case of Banknifty. Gap ups are indicative of the bullishness. But the thing is, the candlesticks are all small body in Nifty and Banknifty, especially in the Banknifty. It's very thin, dodgy body candles, which indicate indecisiveness. The market is not yet convinced that it has decided to move up or down. So anything could happen. Also, the lower low, lower high pattern is not at breached. If you draw a trend line from 9900 downside or on the top 20 all-time high downside, we can see that the trend line channels have not yet been overcome on the bullish side. Neither is the lower low, lower high price action pattern also breached. So it is still not bullish, but a good recovery attempt is what we can see. This is the Bollinger Band view. The Bollinger Bands indicates the volatility. You can see that the expansion is happening on the downside, right? So there is huge volatility, big fall. The bands are expanded, and it has not turned to consolidation yet. But probably the moment it climbs above one of these moving averages, the band may be seen to move sideways, and then some consolidation can become. But as of now, it still remains bearish as per the Bollinger Bands on the daily. On the Nifty and the Banknifty also, because the bands are expanding downside, indicating more probability of downfall. Look at the support resistances. Right, obviously, Banknifty is about 200 exponential moving average, and it has stopped right below the confluence of the 100 and the 20 exponential moving average, and that's the resistance zone that you can see there. So the first resistance would be 250 zone. Then 19300 would be the 100 exponential moving average. 19333 is the previous swing high, previous swing low, right? So breaching that would be a resistance, and then you have the 19335, 19400 rounding number, 19450, and 19523, right? And 19651, 19726, 19805, and 1979. This is a major resistance, which has got a gap also. Downside, this first support would be at the first support would be that gap that you can see at 19175. If that's breached, then you have supports at 18887 and 18829 and 18800 would be a very good support, because it's a gap, and also a 20 exponential moving average support, which was tested earlier. So that could be a good support zone. 19,000 rounding number also can be a support zone. Then 18800 support zone outside. If that's breached, then you go down to 18777, 18700, and then 18600, 18470, 18300, 18200, likewise to 18,000. That's Nifty. Banknifty, you can see that the first resistance on the upside would be to capture the 200 exponential moving average, which is at 43,362, and if that's close, then 100 exponential moving average comes immediately above. 20 exponential moving average comes immediately above that, which is at 43,500. 43,500 is very crucial, and then we have the 43,600, 43,800, 44,000, and 44,100, which is exponential moving average. 44,200, 44,500, 44,700, 44,800, 44,950, 45,000, likewise resistance. So these are all previous swing lows, highs, and then gaps, and the moving averages, based on which the support and resistance are. So resistance and supports can be found in multiple ways. You can have trend lines, we can have Fibonacci retracement, Fibonacci extensions, we can have moving averages, we can have window gaps, we can have all of these combined together to determine the many other techniques are used. So right, what we have used is moving averages, gaps, and previous swing highs and lows to determine where the probabilities of resistance and supports are seen. So let's just, before we move ahead with the momentum of things, let's just summarize the price action that happened last week. So it is a 1% positive 190 points up for the Nifty, and it is a 1.23% 400 plus points up on the Banknifty. That's what we are. So we formed finally green inside per one, and we had made a 7% correction and 9% correction in the Banknifty, and we are still in a rally, of 20%, 21% in the Banknifty, right? So in the middle of that, we made a 7 to 9% of correction. So we're still in that breakout of cup and handle tracking pattern. So value may resume or may fizzle out. No, the time will tell, but we're still in the pack. In daily, we have 0.5% up, 97 points on the Nifty, and the daily charts we have 70% up, 300 points up on the Banknifty, and both have indecisiveness, indecisive G's candlestick pattern. And we have the 200 DMA support for the Banknifty, but 200 DMA is a resistance for the Banknifty, right? And weekly 200, weekly 20 week, we are below that on the Nifty and the Banknifty both. So medium term, major resistance would be clearing that for the next week. Would be clearing the 20 weekly expansion moving average. Right? Daily, the major hurdle will be for the Banknifty to clear and close above the 200 expansion moving average on the daily charts, which is acting as resistance, right? The same which is acting as support for the Banknifty. So basically, market has recovered, and it's at a crucial resistance zones. So is it the beginning of a more fall, or are we done with? We have found the bottom. Is the question that we'll analyze, by looking at the various factors. The Bollinger Bands, we've already seen that it's indicating bearishness as of now. Those expansion is still happening. Let's move ahead and then see the different indicators that gives us more clues. So the momentum and the trend. The momentum indicators, the RSI is indicating, which is having the weekly analysis charts on the left side on the Nifty, and the right side Banknifty daily analysis. So weekly is showing that it is sideways and rising up. Momentum is sideways and rising up. Daily was bearish last week. Remember, now both indices have got daily charts, daily momentum that has climbed from the bear zones into the bullish zones, into the sideways zones. Overall, it's sideways momentum and rising up. That's what the indices are there. Now, the ADX, the trend indicator, is still bearish. It's bearish, but falling on the daily, on the Nifty and the Banknifty. Bearish, falling. That means the bearishness is reducing the short term and the medium term, and as far as the trend is concerned, and the momentum is sideways and rising, which is overall positive, but not bullish yet. Volatility and the open interest analysis is what we next do. Now, interestingly, despite all this correction that's happening, the VIX has not moved up drastically. It has a flat close for the VIX and it's 10.88. Can you imagine? We had a 9% of correction and the VIX is still below 11. This is very, very unusual. This does not mean that there is no fear in the market. This is because of the market dynamics that has come into the recent algo systems and huge number of option players and all that. So you got to be slightly very careful about this fixed factor, which is very unusually behaving these days. But the fact is, intraday the volatility is very high, but on closing basis the VIX is not spiking up at all as much as the market is correcting. This can be taken with a caution because of the unusual behavior, because market falls and VIX is supposed to be at least near to the 12 plus 13, 14, 15, that range, but that's not the case because of the, so that way I have to be cautious. But another way would be to be positive with the fact that the fear and greed indicator is giving us clues that the derivatives players, the option writers are more positive in the market. You can take it either way, but I would like to take it as a little caution. Because spikes from the downside will be very, very big, which are main introverted nature. Now, open interest analysis is the next thing. So it was a short covering build-up that we saw in Nifty and the Banknifty in the last week. This week also, it's a short covering build-up that has happened on Friday on the futures open interest. Now, with respect to the November 8th and this 9th weekly expiry on the options, we have seen that the put-call ratio is not bullish enough on Nifty, but it is bullish. It's crossed the above 1. In the case of Banknifty. So overall, it's neither bullish nor bearish is what you can say, because Nifty is not bullish enough, right? So there's some contradiction between Nifty and the Banknifty with respect to the open interest. So people are more bullish on the Banknifty. Let's look at this. So we can see the greens are all resistances. So huge resistance zone is where we are, right? Supports have a very wide range also. Look at where the highest put and call writing is. In 19,200 and 300 is where the Nifty is, right? Very thin range. But look at where the second highest put and call writing is. It's between 18,000 and 19,500. Same with Banknifty also. Banknifty has a wider range, 43 and 45,000. So option riders are seeing a very wide range where the highest support and resistance can be removed. So they're expecting the market to behave in a very volatile way. Second highest is 41,000 and 43,500, 1,500 points. So Bank Nifty is expected to move in a very wide range, is what the option riders are saying, right? Between the support and resistances for the next week. As of now, this could change Monday, and we have this weekly charts, and then we have time till Thursday. Nifty is slightly different because the Nifty, the people 19,000 seems to be a good support. So market option writers, the big players in the market, especially in the derivatives market, expecting the market would be in a very narrow range of Nifty and a very wide range of the Bank Nifty. But the second highest put and call rating, there's if that breaches, if the 19,000 breaches, the fall could be big. Is also what is indicative of the 18,000 and 19,500 big wide range on the Nifty. So let's make a note of these points. So huge resistance build up, some unwinding. So 19,000 seems to be a very good support zone. Moving ahead, we have tried to analyze how the different industrial sectors have performed last week. So it was overall a green recovery move that has happened. IT sectors moved less than 1%, 0.5% on the metal up, auto nearly 1%, less than 1% up move, pharma 1% up move, FMCG 1% up move, realty big up move of 10.5%. So realty really did well, and that's the only sector which is bullish on both time frames of weekly and daily and ready to take long positions with caution. So realty is a sector that's leading and is bust out last week, and overall the week, if you see, all the sectors are trying to recover and move up, near to 1% and 0.5% in metal. So that's good, but yeah, so the bearishness where some of the sectors had slipped down the short term is no longer there. All of them are climbed back in the sideways, but not yet ready to be in the bullish zones. Look at this, the same sectors in IT had fallen, slipped in the medium term into sideways, right? And medium term metal had slipped into sideways, and bullishness in the auto maintained with medium term having a divergence, bullish in nature, positive reverse divergence, and pharma is still managed to hold on that momentum on the bull zones on the medium term. FMCG has slipped but rising up and trying to come back with the previous momentum, and big breakout of bullishness along with divergence, bullish previous positive reverse divergence, and a huge candle showing the 10% plus moves in the realty sector is seen in this. So that's what the different industrial sectors, how they perform. Now if you analyze the different heavyweight stocks that contribute maximum to the indices, you can see HDFC Bank, Reliance and ICICI Bank comes into the picture the first because they contribute to most of the index. You can see that HDFC Bank has behaved just like the index, and it's consolidated and created an index inside bar and after the big fall that happened the previous week, and momentum is still in the bear zones, and on the medium term has not been able to climb back into the sideways zone at least. So HDFC is bearish. Reliance has taken an RSI support at 40 and then climbed back. Same with ICICI Bank, also near to the RSI 40, it has taken a support and climbed back. So sideways rising is what the two big Reliance and ICICI Bank stocks are telling, but HDFC remains in the bearish on the medium term. IT sector has slipped in the sideways, but rising in the sideways is what the momentum is indicating on the weekly or medium term. Bank sideways taking a support of the RSI once again, and then trying to move up after a decline of several weeks. ITC has also slipped in the sideways but trying to move up and still very close to the all-time high level. So overall it's all sideways across all. No major stock in the index is leading and breaking out and then holding it as resistance, because the selling is happening when the Fyers on these, and big selling happened in the HDFC Bank primary. So Fyers hold the heavyweight stocks and Fyers are selling the heavyweight stocks. So this is a concern that there is no leader who is in the bullish momentum zones that could drive the market upside yet. fact is none of them are bearish either. All of them are maintaining the sideways movement also. So that's what we understand from the index heavy analysis. Here comes the institutional participation. Foreign institutions continue to sell. It's not the 14th, it's probably the 16th week, I would guess. If I'm not mistaken, it's the 16th week of selling continuously, consecutively doing that, and with 5,500 crores of selling last week as well. The day as a common setting for that, it was all green, everyday buying, almost equal by the domestic institutions. Net it's still red. So net longs on the derivatives for foreign institutions and domestic institutions have moved down last week slightly. Right. So unless this last 6-7 months of selling stops, we cannot expect the market to move upside. Right. All the buying is happening from the mutual fund money that is flowing in from the retailers in India. So that's a concern. So moving ahead, if we try to analyze the global markets, that's the US markets, primarily indices, the currencies and the commodities, we'll try to understand better what's happening outside there. So the dollar index has cooled down 1.43% of down move and it's at 105. Right? It's kind of positive. Because up move was at almost 7% and it has slipped. The momentum has slipped in the sideways in the medium term. Right? You can see the charts here on the right side. I have read huge resistance and after the breakout from the cup and handle is what you see there. Momentum has slipped in the sideways in the bullish zones. That's positive, but it's not reflecting as much. Not necessarily, but it's not reflecting in the USD and our currency pair. It's still at 83 plus. Right? Still the big rupee remains very weak. But the momentum has slipped in the sideways and falling. It's a really positive thing. That remember, we are in the top of a ascending wedge, so we are expecting a breakdown that could happen at any time. There are a lot of space on the channel top, and the dollar was rising all this time. Slight dip, which is a positive. And crude oil also has seen a big downfall. Gold also is finding some resistance at the same previous resistance zones, and after the moment having climbed to the bull zone. So if we just summarize, it's a 5% down. 80.83 is where the crude is a relief. 5% down is very good. Along with the dollar also moving down, it helps. Gold is finding the resistance there. It's less than 1% down. After breaking out from that. Cup and handle channel. Once again, it's very resistance there. US markets, if you see, if the Dow Jones is there left on the top right, you have Nasdaq, and down you have S&P 500. All of them are showing big up move, big wide range bullish candles as seen all last week after the Fed came out with a less hawkish or more dovish, more of a dovish outlook speech or something has happened. So market's reaction to that was positive, right? So that's the reason probably we also recovered. So US markets are green. How much green is that? It was 5%. Dow Jones 6.5%, S&P 500, and Nasdaq 6%. So 5 to 6% of up move is really good thing. Right? Momentum is sideways and rising up. Right? That's what we are. So that's positive thing. So just to wrap it up, because global cues have turned to be fair enough in last week, considering the fact that the dollar has cooled off, crude has cooled off, and the US markets are solid green. Let's get into some pickups, stock picks for the next week. Reality, the reality sector, we know that it's 10.5% of broad break that happened. And one of the stocks that can give opportunities on the long side towards the top of the trendline channel is Opera Reality. On the weekly chart, it shows decent volumes, rising the bull zones, trying to cross over the bullish momentum, and a very good risk reward if you're getting out right below it, the one at the bottom of the entry candle of the last weekly candle. Right? It's a breakout from a parallel channel as well as it's in a trendline channel. A lot of space is there towards the top that could possibly give you opportunities for swing trading opportunities of 1 or 2 weeks max. But loss of IT sector has also seen some recovery because of the Nasdaq up move, and Birlasoft is a mid-cap stock and it has been performing much better than the large caps where the selling is happening. Momentum is absolutely bullish with divergences indicating for upside. It's a rounding pattern breakout that is confirmed. Good risk reward to the all-time highs near to 690 can be possible given the bullish momentum and the huge volumes. Big buying is happening. Somebody is buying. And it's a Birla group stock, which is confidence of the investors as well. So it would give good swing trading opportunities 1 or 2 weeks on the upside. Right. So it's two stock picks, one from reality, one from the IT sector. Another pickup for the weekly options index strategy. This is a double diagonal current spread, completely hedged, very good range. Decent risk reward flexing early and good decent probability of profit. Basically, we are selling put and call options for this week and then buying hedges for the upcoming week. Right. So let's rewind. It is very less premium and very wide range and pop. Right. So let's give consistent rewards. For what just also look at the range that we are getting between 19,000 and 9,600 is exactly we would that the market would move unless some black swans come in. So most probably there won't be any need for rolling up and down for adjustments. If you hold on the positions, but if in the worst case something happens, even then we can roll down or roll up on either side to adjust and then still maintain very less loss, right? So that's a pair of charts that you're seeing for Nifty weekly options trading strategy. After having seen the actionables and complete analysis, let's summarize it. Last week, basically, the market attempted to recover after a sharp fall in the previous week, and then the green inside bar indicating some consolidation after 7 to 9% of correction from the all-time high, right? It has gained some momentum, but remember we are still in 20 plus percentage of breakout from cup and handle and all flat patterns and all that. Now the previous swing highs and moving average resistance is still there. We are at a resistance zone right below that, right below in the resistance zones, and there is a downside change in probability probabilities there, just like how we are with the previous. So basically the previous supports could act as resistance and then can pull the market down, so that possibility is there. The trend indicator ADX is showing that it's negative. It is still not crossed out the bull zones, not in the short term, neither in the long term. So PCI is not bullish enough yet on the Nifty. All the bands are bearish. Intensive small body candlestick patterns are there. Right? These are all factors that gives hope for the bears that could expect that it is just that can bounce and then market could fall back again. So what gives hope for the bulls is the green news markets, the dollar cool off, oil cool off, momentum climbing up from the bear zones to the short, to the short term sideways zones. Short covering build up that is seen in the futures open interest and VIX remaining low. All of these factors that gives the bulls the hope. So market basically attempted to recover after a sharp falls. All the eyes would be on whether this decent correction has found a bottom, and or is it going to be a more fall after it hit the resistance and then it's making a lower low, lower high pattern. So that's what I have a mild bearish view. I may be wrong, but mild bearish view is what the charts are indicating, right? Although there are positives and negatives. The view for the next week remains to be mild bearish, right? It may be consolidating for some time, some neutral movement also, but overall mild view from the charts is what I get. You can have a different view. All you have to do is have a market view and place your bets, and then have tight stop losses, manage your risk, and then change accordingly, and then adapt to it. Right. So global cues are still on the great Russian face, and the interest rate worries and war and all this could escalate in a moment, and black swans could come in anytime. So you have to be completely hedged and manage your position. So levels for the next couple of weeks will be 18,800 to 19,500 on the Nifty, and then 41,500 to 44,500 for the Banknifty. So 19,000 and 43,000, if that is maintained, probably there is a hope that the recovery may end up to be in favor of the bulls, and then it will continue. But if that is not held, then we may be consolidating, or maybe even getting ready for a even more bigger corrections, right? So always have hedge positions, and when you're taking options, no overnight risk, please. Protect your capital, that's all. Will help you stay in the game for another good trading day. Otherwise, your wiped out will not be anywhere. So also these option strategies can be used for buying or getting rental incomes. The option strategies playlist, you can check out that. Protect your capital is all that you can do. You can always take these opportunities to invest in SIPs, more on quality stocks, and also make use of this cash rocket puts and cover calls and all that. Check out the playlist for the other videos that are not weekly analysis, right? So there has a lot of information about uh, how to play the options. So play it safe, and happy trading, happy learning, happy investing. Subscribe and share to friends and colleagues. We have social media channels. Subscribe to that also. We have daily charts and analysis and a lot of content that's put in there. Subscribe to that and share to friends and colleagues. Thanks for watching. Happy trading, happy learning, happy investing. Bye bye.